We discuss non-banking financial institutions, and we know what is a banking financial institution. Banking in a financial institutions accept deposit from people and lend money to the people, but their liabilities are considered as uh, liabilities are considered as some kind of medium of exchange, because against liabilities, the banking institutions have the power to issue the check, and the check actually help us to transact goods and services in the economy. In that way, means the banking institutions means engaging payment activities, transactions activities in the economy, and their liabilities could be considered as a part of the money supply in our economy. So therefore, banking institutions are a particular type of institutions engaged in lending and accepting money, and thereby they are also participating in the payment system, adding to the money supply of the country. And banking institutions, of course, have been given license, or they need to get the license from the government, and they are strictly under the control of the central bank of the respective country. So banking institutions are very important in the sense that they can create money in the economy. But non-banking institutions, they can also accept money from the people, and they can lend money to the people, but they are not empowered to issue any kind of check to the people. So therefore, that it does mean that they cannot accept any demand liabilities, and they can accept long-term liabilities against which they are not empowered to issue any kind of check to the people. In that sense, non-banking institutions or non-banking companies are not entitled to be a part of the money supply system in our country, or their liabilities do not contribute a part of the money supply system in our country. Let us see the definition of the non-banking institution, or or non-banking financial company. Non-banking financial institutions are organizations that facilitate bank-related financial services, in the sense that they do accept money and lend money, but does not have a banking license. So far as they do not have a banking license, they cannot perform all functions of money. So they do some functions of money, but they are not entitled to do all functions of money, in the sense that their liabilities, the non-banking financial companies' liabilities do not form a part of the money supply in our country. So you can give a good definition, means of the means non-banking financial company, and that definition looks like this: non-banking financial companies supplement the role of banking sector in meeting the increasing financial needs of the corporate sector, delivering credit to the corporate sector to small local borrowers. So means they help the financial system in many ways. They lend money to the people. They help the system by giving money to the needy nerve sectors of the economy. But unfortunately, this non-banking financial company does not become a part of the payment system, transaction system. Therefore, they are not like bank. They are not entirely like banks. They are like banks, but they are not entirely like banks. That's the main difference between these two things. And we now explain the role of the non-banking financial institutions. Or so let us see. Before that, we will discuss the difference between bank and non-banking financial company. So non-banking financial company cannot accept demand deposit, but a bank can accept a demand deposit. That's a basic difference. A non-banking financial company cannot accept a demand deposit. So if it does accept a demand deposit, then it will have the power to issue the check. So a non-banking financial company cannot accept a demand deposit, but that can be accepted by a bank. So this is a chief difference between non-banking financial company and the bank. Secondly, non-banking financial company do not form the part of the payment or settlement system, that I have already told. The non-banking financial companies, they do not form a part of the payment system, and they cannot give check draw on themselves. So they are not empowered to issue check as banks do. Deposit insurance facility of deposit insurance and credit guarantee corporation is not accessible to depositors of non-banking financial companies, which is usually available in a normal bank. So if you deposit money in a normal bank, then you can avail the deposit insurance credit guarantee corporation services. That will be given some kind of insurance. Your deposit will be provided some insurance if you deposit money in a normal bank, in a commercial banks. But if you deposit money in a non-banking financial company, that will not have any kind of deposit insurance facility being offered by the deposit insurance credit guarantee corporation. Fourthly, in banks, foreign investment is allowed only up to 74%, and in non-banking financial company, it is allowed 100%. But there may be some differences. You need to check the latest information regarding that if I am wrong. But means as far as my knowledge goes, in banking, in banks, foreign investment is allowed up to 74%, and in non-banking financial company, it is allowed foreign investment is allowed 100%. Then CRR or cash reserve ratio is applicable only to banks, but not applicable to non-banking financial company, because the non-banking financial companies need not keep any cash reserve ratio, cash reserve ratio, uh, cash reserve ratio, but banks have to keep the cash reserve ratio. Then capital adequacy ratio is applicable in banks, but they are not so applicable in the case of the non-banking financial companies. So these are the basic differences between banks and non-banking financial companies. Let us look at the features of non-banking financial company. Non-banking financial companies are permitted to accept or renew public deposits for minimum of 12 months and maximum of 60 months. So minimum 12 months and maximum 60 months, minimum of 1 year. That's a minimum. Non-banking financial company cannot offer higher interest rate. It should fall under the ceiling rate that is specified by the RBI. The interest must be paid or on a monthly basis. So a non-banking financial company cannot offer a high interest rate to its depositors. Non-banking financial company cannot offer any other benefits to the depositors, because they cannot offer check to the depositors, any other benefits they cannot offer to the depositors. The deposits with non-banking financial company are not provided insurance, that we have already explained while discussing the guarantee offered by the deposit insurance corporation. We explained that non-banking financial companies, if you deposit money in a non-banking financial company, then it is unlikely that you will get some kind of insurance against your deposits. Then the guarantee of repayment of deposits by non-banking financial company is not provided by the RBI. Any guarantee, so your deposits do not get any kind of guarantee from the RBI if you deposit money in the non-banking financial company. Let us see the functions of non-banking financial companies. The first function is hire purchase service. What is a hire purchase? A hire purchase service is a way through which the seller delivers the goods to the buyer without transferring ownership of the goods. The payment of the goods is ensured to be made in installments. Once a buyer pays the installments of the good, then the ownership of the good is transferred to the buyer. So you have to make an installment, you have to make payment in installments, and once you finish all installments, then you will get the ownership. That's what's called hire purchase services. And non-banking financial companies engage in these hire purchase services. Second, retail financing. Companies that provide short-term funds for loans against shares, gold, property, primarily for consumption purposes. So the non-banking financial companies can engage in retail financing. Trade finance, companies dealing in dealer distributor finance, so that they can work for, they can make working capital requirements, or means they can provide working capital to vendors, to other companies, to as business loans, etc. So in trade finance also, non-banking financial companies help the economy a lot. Then infrastructure funding. This is the largest section where major non-banking financial companies deal in. A lot of means a lot portion of this segment alone makes up a major portion of the fund lent by the non-banking financial intermediary. The majority includes real estate, flyovers, railway, metros, ports. So for the construction of all these things, non-banking financial companies offer finance. Asset management is another important function of the non-banking financial company. Asset management companies are those companies that consist of fund managers who invest the funds put by small investors and actively manage it. Then venture capital services for startup or for those companies which are the early stage of development. The non-banking financial companies may offer credit to such companies. And finally, the NBFC, non-banking financial companies, offer credit to micro, small, and medium enterprises. So these are the important means functions of the non-banking financial companies in India.